Hello, traders, and welcome to Simpler Trading. My name's Melissa. I am one of the traders here. I trade in the trendy room as well as the SPX room, and I am so happy that you joined me here today. I want to talk about something that I believe is the first step in becoming a consistently profitable trader. It's great to know what your trade plan is or know which strategy you're trading, and all of those things are very important. But in my opinion, I believe the most important thing in trading and how we become successful in trading, beating the other 90%, is by managing risk and setting stop losses. So, that's what I want to talk about today. Let's get started. I'm going to make this full screen here. You won't see my face, but obviously I am here and talking to you. So I want you to imagine this. You're up 200 bucks on a trade. You head to the kitchen for a cup of coffee, and when you return, it's down 400. Suddenly, your laptop feels like an enemy. Does that sound familiar to anyone or just me? You're definitely not alone. A staggering number of retail accounts fell, not because their entries are bad, but because no one ever taught them a strategy for how to exit. Today, I'm sharing the exact checklist that I use to manage a trade from start to finish. No jargon, no gurus, just simple rules that fit on a sticky note and helps to save your account. Let's talk about the why that nobody says out loud. Most videos will start with a candlestick charts, but let's kick it off with a truth. A stop loss isn't just a safety net. It's a business expense that defines your trade idea. Think of it as the cost of finding out that you're wrong. If you can't point to an exact technical level on a chart that proves your trade idea is invalid, then you're not trading, you're just hoping. Write that down on a sticky note too. If you're not trading and know an exact technical level on a chart that proves your trade is invalid, you're not trading, you're just hoping. And we all know where hope leads in trading, right? So, let me talk about how I define my risk tolerance. Number one, it is very important for you to understand that when I talk about risk tolerance, any trade that I put on, I am risking only an amount that I am comfortable with emotionally and an amount that won't wreck my account. Okay. Before I even start. So, before you hit that buy button, you need to ask yourself three quick questions. Number one, what dollar amount am I emotionally comfortable with losing on this single trade? Whatever amount popped into your head just now when I asked you that question, I want you to divide that in half, because realistically, that's probably closer to the a dollar amount that you are emotionally comfortable with losing. The second question I ask myself is, does that amount put my account in jeopardy? What do I mean? I mean, if I'm trading from an account that has $1,000 in it, and I say, oh, I'm going to risk $500 on this trade. In my opinion, that would be putting my account in jeopardy. A more realistic amount, if I was only trading $1,000 account, would be a 50 to $100 risk. Okay. That's the second question I ask myself. Does the amount put my account in jeopardy? And number three, at any given time, am I risking more than 50% of my total account balance across all the trades I have open. That includes, if you're a swing trader, that includes all of your swing trades added up. If you're a day trader, all of the current trades you're currently in, if you add those all together, the amount that you have at risk, is it over 50% of your total account balance? If you find a percentage that you're comfortable with, maybe 50% of your account is not a percentage you're comfortable with, and that's okay. Maybe you're only comfortable with risking 25% of your total account balance. It is your responsibility to look at all of the open positions you have on at any given time and know, do you have more a higher percentage of your account at risk than what you're comfortable with? If the number makes you nervous, you need to lower it until it feels boring. Boring is good. Boring helps keep us trading next month. Okay? All right. So now let's talk about how I set my initial stop. I have a buy zone right here. Whatever strategy you use to trade to create a buy zone is completely fine. You can use this risk management strategy with any type of trading that you might be doing. For me, I concentrate mainly on inside candles as a candlestick pattern to trade, and I use a lot of Fibonacci. So on this example of SPY, I would create a buy zone here at 653.21 by 650.63. My stop is a candle close below the 650.63. So if I'm looking at a 4-hour chart right now, I am committed to that 4-hour candle. All right. That gives me a risk of $2.58. Now, because I commit to a candle close, that risk could end up being higher. And that's why it's so important for me to only trade an allocation amount that I am comfortable with going to zero. But for right now, the buy zone is $2.58 wide, and my reward is $5.12 away. This would be a trade that I would be comfortable with taking because the risk is less than the reward. Okay. And again, just to reiterate, I stop out on a candle close, not a wick. Now, you might ask yourself, why do you commit to a candle close? And about 3.5 years ago, when I started trading with Trendy John, he encouraged this type of trading, not being wicked out. Why? Because oftentimes market makers will wick you out of your trade. They will hit your stop level with a wick, and then you watch as you already stopped out, you watch price continue in the direction that you had originally mapped out. That is very frustrating, right? So, it must be a full candle body closing past my stop on the time frame that I'm trading. This single rule prevents me from getting shaken out by noise. All right? All right. So, am I comfortable with my loss? That's the first question I ask myself. Is too much of my account at risk? Second question I ask myself. And the third question, do I have a higher percentage of my account at stake or at risk than what I am comfortable with? It's a balance, guys. It's important to know all of these things before entering a trade. I have been in trading rooms on the other side of this mic, and there are so many great trades that come across. And in the beginning, I was putting them all on. I don't know if you've ever been there. I have. Not paying any attention to the total risk I had out at any one time. And there was a time, it was in December, I will never forget it. It was in December that I had about 80% of my account at risk, and it was all centered around one particular area of the market. The market crashed and I lost way more than what I was truly comfortable with losing. That's why I ask myself those 3 questions every single time. Now let's talk about the different types of stop orders. A fixed stop is the one I want to talk about first, and it is probably the most common type of stop. A fixed stop Sorry. A fixed stop is the line in the sand. It's that initial stop that I showed you at the bottom of that buy zone. It is based on that technical level, right? The bottom of my buy zone where I'm expecting buyers to step in. It is there in place and it doesn't change. It's a technical level. Then we have a trailing stop. Trailing stops automatically move your stop up as the trade is going in your favor. And I'll explain when I use each of these later on. Next up is a stop limit order. I don't really use these, but I wanted to cover it because it is a type of stop. A stop limit order will only fill at your exact price. That can be risky in a fast moving market. And don't forget the unsung hero, a time based stop. A time based stop is related to the expiration on the option contract. So, for example, if I am trading monthly expirations and I'm in a swing trade, the trade is going in my favor. I have some profits locked in, but we're getting down to the last week or especially the last couple of days to expiration. I haven't made it to my final target and time is no longer on my side. This is when I will use a time based stop on my uh, swing trade, especially if the momentum that was in my favor is dying out. And of course, you can use JC's new momentum indicator to get an idea of that, right? You see a momentum reversal arrow on a daily or 4-hour chart, and you're in a trade, you only got a couple of days to expiration, it's probably good just to go ahead and exit your trade where it is at right then. Okay. All right. Now let's talk about position sizing. All right. In this example, this is again that SPY buy zone. Okay. I want to just hypothetically say that I have the amount I'm comfortable with risking on any one trade is $500. So my total allocation is $500. Inside of my buy zone, I have two areas that I want to buy. The first being the top of this zone at 653.21, and the second being towards the middle of this zone and another technical level, 652.05. What I do is on the first entry, I am looking here at the money calls. That's I only trade directionally. I'm buying calls or I'm buying puts and I like to trade at the money. So I'm looking at the money calls and they cost $1.69. All right. If my total allocation is 500 and I have two entries, I just divide that in half That means at each entry, I can spend $250. Well, can I buy two contracts for $250? I cannot. So on the first entry, I would be buying one contract. Then I have my alert set or an automatic bid set here to buy at my second entry. And at that point, my option price will be less than $1.69 because price is moving against me. So the value of that option would be going down. It would be cheaper. And at my second entry, I would be able to buy two to three contracts more than likely. You would have to do the math on an actual trade, but this will give you an idea. The important thing is if I spend $1.70 here, I know that I have 330 more dollars to spend at my second entry, and I buy the number of contracts I can afford for whatever the price is going for. All right? That's how I position size. It doesn't matter if it's a swing trade, a day trade, or a leap trade. I use that exact same process to determine my position size each time. That is how I position size each account. All right. Now I want to talk about some, sorry, woo, a uh, once I'm in a trade, I'm not just going to put it on and never look at it again. It's so important that each day, at the end of the day, usually like the last 30 minutes in the day, I am looking at my open positions. I pull up the charts that I built my trade plan on, and I am looking to see where price is at, especially if I've collected profits and have my stops in place. Do I need to move a stop up? Those sorts of things. So, this mid trade audit that I'm going to talk about now, that is how you should create a routine every single day. It is crucial for options, especially as we get closer to expiration. So, set a calendar reminder, have Alexa reminder, whatever you need to do. Write it on a post it note, your expirations on your current trades, whatever works for you. Just make sure that you are aware of when your option is expiring. And if we're getting into that week of expiration, you really need to audit your trades. You're looking to see, is there still momentum? Is it going in my favor? Yes or no? It's a simple question. You shouldn't have to question or worry about. If momentum is still or is not going in your favor, then that is a time that I would just go ahead and take the rest of my profits there. All right. Sorry, guys, my allergies are horrible. Now, let's talk about another part of managing risk and how we protect our capital by not getting into trades that are not beneficial, so to speak. All right. And that is related to risk to reward. It's not all about a ratio, it's about a filter of the trades that I'm willing to take. So let's say that you are looking at a trade and the risk is 50 cents and your reward or your first target is 40 cents away. For me, a less than 1-to-1 risk to reward is a no trade. I'm not going to waste my mental capital, my emotional. Hold on one second. Sorry. I'm not going to waste my emotional capital on a trade that has less than a one-to-one risk to reward. And honestly, I would prefer a trade with at least a two-to-one risk to reward, or I should say one to two risk to reward. All right. So if I am looking at a trade and the risk is 50 cents and my reward is a dollar or $2, that is amazing. That is a trade that I'm going to take every time because the risk is less than the reward. Look, casinos stay in business because they understand the math, and now you should too. You need to skip any setup that offers less than a one-to-one risk to reward. And really, I would be scouting setups that are giving you a one to two risk to reward. Believe me, your future self will appreciate that little tidbit. Now, let's talk about some common mistakes that can punch you in the face. Okay. And this is kind of a touchy subject, probably. I know it was for me back in the day. And that is moving your stop because a trade is going against you. You should not move your stop because a trade is going against you and you have in your head it'll come back. Look, the market hates that. It's going to take advantage of you. Another classic mistake is getting stopped out by a quick price wick, right? I told you I commit to candle closes. Getting stopped out by a quick price wick, that's very, very frustrating. So do your best to avoid that mistake. If your rule is to wait for a candle close, stick to it. If you're becoming uncomfortable and emotional about being in that losing trade, it probably means that your risk amount is too high. Letting a quick stab of volatility scare you out of a good trade plan is a rookie error. Set your stop level, define the conditions for the exit, and then let the market prove your trade idea is right or wrong. Those are the only two things that can happen. Let's talk about the psychology of a losing trade. Here's the reality, guys. You're not afraid of losing money, you're afraid of being wrong. I'm not afraid of losing money. I'm afraid of being wrong. That's the money part. Yeah, that losing money sucks. But as human beings, our ego is the thing that really causes us to make some of those common mistakes. You don't want to be wrong. Once you can separate your net worth from your ego, stops turn into receipts and not report cards. That's powerful. Think about that because once you're okay with being wrong, then your stops are nothing more than a receipt for a trade idea that, hey, you just weren't right about. Okay? All right, now let's talk about how I use stops and how I move my stops up as a trade is going into my favor. This is how I manage a winning trade. Okay, so in this first example, here's my original stop. Price has moved up to my first target. At this point, I create a break even stop on this trade. I exit the set number of contracts that I had planned to exit at the first target. Let me give you an example. Let's say that I am long 4 contracts here. At that first target, I want to take off or exit anywhere from a third to a half of my position. So in this example, I would cash in profits on 2 of those 4 contracts right here at my first target, and I move the stop to break even. In this case, where I entered the trade would be my break even stop. Now, you can put a hard break even stop here, or you can just create an alert for your stop, up to you. Second, example here is showing once I have hit that first target, I have a stop at break even. Hypothetically, we're up here at my second target. This is when I use the Fibonacci retracement tool and I run it from the bottom of my buy zone up to the current price. I find the 38.2 Fibonacci and I move my stop to that level. Now, I've hypothetically hit my third target. I'm going to do the same thing. Sorry, back at the second target, I have 2 contracts left. I'm going to sell one, and now I am in one runner contract. At third target, I just adjust my fibs, moving them up to the new high or where price is at. I only have one contract left here. So for me, I would not exit that contract. I will hold on to it. It's a runner position because I'm targeting 665.45. One of two things are going to happen. Number one, I've traced my fibs up to the new high. I have a higher stop on that remaining position. I stay in as long as I do not get a candle close below this stop. Then, if and when I make it to final target, I have one of two ways I can handle this. The first way is, hey, I'm at final target. I'm taking my money here and see you later, market. Or I can place a trailing stop here and then what I like to do is, let's say the value of this option that I have left is $5. I will use a 50-cent trail stop at my final target. That's 10% of whatever the option premium is worth there. That's what I like to do. So let's re- recap this real quick. All right. Got your emotional risk amount written down? Check. Identified the technical zones and the stop level? Check. Sized your position using the math? Check. Set your alert for a candle close, not a wick? Check. Defined your target levels for moving the stop? Check. Have a plan for time decay near expiration? Check. Now you can lose the right way, and losing the right way is just the cost of doing business. Next time you feel that coffee break panic, you won't freeze. You'll glance at the sticky note, remember your plan, and let your strategy do its job. When you master this process, you will when you master this process, you won't need to chase home run trades. You'll keep hitting consistent singles and doubles while everyone else swings for the fences and strikes out. I hope you found this valuable. It has allowed me to be a consistently profitable trader because I no longer swing for the fences on my trades. I take what the market gives me, and that has allowed me, even on very choppy days like today. I'll show you a chart example of SPX here because today is definitely a choppy day. And rather than swinging for the fences, I've just been taking what the market gives me, hitting easy singles and doubles as price has moved to my very, very reasonable targets. Let me show you. Toss for some reason is freezing right now. There we go. All right. All right. So I'm going to show you what I'm talking about here. I think we can all agree that ES, at least, has been very choppy, right? It was in this chop zone. It finally broke above. We created a new all-time high, and that's great because I have a trade on right now to the upside. But all day today, I have had close targets. So if I'm getting short, for instance, below 65.85, I'm taking my profits here right about 4 points below. Is it a home run? No, it's a base hit. Same with the upside. If I am long above my PMZ right here, guess what? I'm taking profits at 65.90 and 65.94. It is base hits over and over. I'm not swinging for the fences. And as we hit these targets, right? Like for instance, this one here, when I came on 30 minutes ago, I had this trade on from the PMZ. When it hit this first target, I simply put in a break even stop for the remainder of the position. Now it's hit my second target. So, guess what I'm going to do? I'm going to take this run. I'm going to run those Fibonacci's like I told you about, and I am going to watch 65.91. Does this hold as support? If it does, I can stay in the remainder of my position up to my final target. All right. Anyway, I hope y'all found this information valuable. Thank you for joining us. If you're not already a member at Simpler Trading, or if you're not already in the Trendy Trading Room or SPX room, I invite you to join John and I in those rooms. We trade our own money live every single day. Not only that, but we spend a great amount of time teaching, educating, and helping you become a better trader. So join us in those rooms. We would love to have you. Y'all have an awesome rest of your Friday and a great weekend.